approach to very incremental rate rises doesn't cut it, and you actually need to intentionally widen credit spreads. Not a conversation we need to have right now, but it's a scary conversation we may need to have next year.
A conversation, no doubt, we will be having at some point. I just have no idea when that's coming, of course, because I don't make any calls. Pfizer down by about 0.5% in early trading, publishing some new data on its experimental COVID medication. The CEO, Albert Bourla, saying the following: emerging variants of concern like Omicron have exacerbated the need for accessible treatment options. We are confident that, if authorized or approved, this potential treatment could be a critical tool to help quell the pandemic. With more on this, here's Abby.
Hey, John. Well, before talking about that solution from Pfizer, we do have some breaking news out about 10 minutes ago and a read spike on the Bloomberg terminal. And this has to do with the headline that Italy is said to introduce mandatory testing for travelers from other EU members. Now, this is similar to something that France did last week. Portugal, one EU member, to require testing from travelers from other EU countries. So some fragmentation in the EU, of course, having to do with this new variant. Italy yesterday extending their state of emergency until March 31st on the variant. So it's all about this new variant. Now, the good news relative to Pfizer, relative to that pill, but also their two-dose vaccine, that two-dose vaccine is, in fact, 70% effective against hospitalization, but only 33% effective against Omicron. And you can see some weakness right now here for these vaccine makers. This, of course, was after a big rally yesterday. But relative to that pill, it is 89% effective against severe disease and death. So that is certainly good news there relative to that pill. But relative to death overall on a global basis, it is ticking higher. On a 7-day basis, it's a bit higher than 7,800 deaths per day. A very sad, tragic figure. And there's some thought, as you know, John, that the booster could be the real solution here. A third shot in the UK, they are leading those efforts. 28% of the population is boosted. It's going to be very interesting to see, of course, how all this plays out. But again, Italy is said to introduce mandatory testing for travelers from the EU, really emphasizing the gravity of this Omicron variant.
That number in the UK keeps climbing. There's been a massive push over the last week. Abby, thank you. Looking ahead to next year, your S&P 500 2022 forecast at the top of the pile, 53.30 over at Oppenheimer, BMO at 5,300, Deutsche Bank at, I think, 52.50, Credit Suisse at 5,200. Interesting that JP Morgan's at 50.50, but Marko Kolanovic, I think, has got one of the most constructive views for next year on the economy. He says the following: 22 will be the year of a full global recovery, an end of the global pandemic, and a return to normal conditions we had prior to the COVID-19 outbreak. This is warranted by achieving broad population immunity and with the help of human ingenuity, such as new therapeutics. Now, Gene, I want a response from all of you on this call that's coming out of JP Morgan and the investment bank, because, Gene, this sounds a little bit like some of the calls I heard 12 months ago when we had the efficacy data in early November. 22 will be the year of a full global recovery. Gene, do you agree?
Well, that sounds like words of a doctor, not a banker. I hope that's true. Certainly there's been a lot of developments both in how we treat COVID, not just how we try to prevent it. And I think those things will help us move forward. But it's really hard to tell at this stage. And, here we are at the end of 2021 still dealing with a virus named after 2019. So, it's really hard to have that degree of confidence at this stage.
That is such a good point, Gene. And I really hope to God we're not at the end of 2022 still talking about the same thing. Clinton Warren, your take, please.
Yeah, I just feel for all the families that are stricken with the pandemic and society as a whole. It does seem, though, that with each variant, the economic impact does become more minimal and has a lesser effect on economic conditions. So I'm hopeful that in 2022, as different variants come, there'll be less and less and less, and science will continue to evolve. And I believe in science, and I believe in what the drug companies have been able to do. So I'm hopeful that we will get to a full economic recovery in 2022.
Emily Rowland, final word. Not hope, but what do you expect?
Yeah, I think that, we've seen this divergence in terms of the degree to which you've seen more heavy-handed restrictions by different parts of the world. Clearly Europe implementing, some degree of lockdown, some degree of restrictions. We're seeing China take a very draconian response to COVID. In the U.S. here, we were implementing ways to learn how to live with it. And that's one of the reasons we've continued to see economic growth in the U.S. outshine the rest of the world. And we expect that in 2022 as well. We have a better economic growth trajectory here, better earnings growth trajectory reflecting that economic backdrop that's solid. So we think that's one reason to continue to embrace U.S. assets into next year.
Emily Rowland, Clinton Warren, Gene Tenozzo, and to all three of you, can I just say thank you for your contribution to this show this year. You help make it what it is. Thank you very much. Gene, Clinton, Emily. Coming up, investors preparing for Fed tightening.
Even though folks have known about this, they've been preparing for it, I think there's a difference in terms of the actual effect in markets over the next several months.
The latest fund manager survey out of Bank of America is up next. This is Bloomberg.
This is Bloomberg's The Open. I'm Rishka Gupta live in the principal room. Coming up, Jim Farley, the Ford President and CEO. That's at 12 p.m. Eastern, 5 p.m. in London. This is Bloomberg.
The Fed has turned really hawkish.
This more hawkish tilt.
The biggest, I guess, sting in the tail.
They're getting really aggressive.
Hawkish scenario.
We're all of a sudden having to digest.
You kind of want to be de-risking in the next couple of weeks.
Just one day to go. Investors positioning for the Fed's final rate decision of the year, a shift well illustrated in Bank of America's latest fund manager survey. They write the following: hawkish central banks sparks surge in cash and more defensive asset allocation. If the December FOMC is dovish, then crypto, unprofitable tech, banks and emerging markets would rally. If hawkish, cash stays cash. Let's bring in Kaylee Dice for more. Hey, Kaylee.
Hey, John. Well, on those cash levels, cash allocation was the highest in the survey going all the way back to May of 2020, while equity exposure was cut to the lowest since October of last year. And it's hawkish central banks, as you said, that really top the list of tail risk that investors see, actually at the #1 spot for the first time since May of 2018. And that goes hand in hand with #2, which is inflation. And you also have the COVID resurgence, asset bubbles, and geopolitics as potential causes for concern. But just to focus in on those two top risks a bit more, on the hawkish central bank's point, about half of investors surveyed expect the Fed will hike rates twice in 2022. That's a greater share than saw that back in November, and the share expecting one or no hikes actually shrank in the month of December. And we have to put that together with the survey findings on inflation. 55% of respondents still say it's transitory, though that's down slightly from November, and 36% view it as permanent. And finally, as for what fund managers see ahead in terms of returns for 2022, EM equities are expected to post the best ones. That's followed by the S&P 500, and then two commodities, oil and gold, make the list. And #5 in terms of best returns, John, Bitcoin. I'm just going to leave that one there.
We can leave that one right there and pick up on it in just a moment. Kaylee, looking forward to the close a little bit later. Kaylee Lyon's getting some rest this week, filling in for Caroline Hyde. You enjoy that, Kaylee.
Thank
I've
you
forgotten
very
what
much.
sleep is like. Thank you very much. Sentiment shifting in the defensive side in December, but the survey also highlighting the following. Investors are very cautious, but few outright bearish. David Jones of Bank of America joins us right now. Now, David, you're perfectly positioned to help us with this fund manager survey. Typically, when you see cash rates go north of 5%, that's a buy signal. But what we've seen is an equity market still climbing to all-time highs. So, David, walk me through how that number helps in any way at all at the moment.
Yeah, you know, it is interesting, and thank you for having me. What we're seeing is really very much a reaction to the repricing of central bank rate expectations. We're seeing that people are starting to react more to the idea that central banks are going to have to be more aggressive going forward. And you can see that throughout this survey. You know, the cash is very much a reaction to that, but we don't see the other key supports in place for a very pronounced rally following you know, the central bank decision tomorrow. Instead, what we think is that if the Fed is more dovish than expected, we could see a boost to perhaps some of the more speculative aspects of the market, crypto, unprofitable technology companies, those sorts of things will probably rally. And that is what's probably most, what flows out of that cash under assets under management figure.
David, what's interesting to me as well, just pouring through the fund manager survey, when I speak to people on any given day, there's a fear of a policy mistake, a Fed going too quickly, inflation not getting out of control but remaining at elevated levels. And I'm pouring through this and looking at what the respondents have told you guys. 55% still think inflation is transitory, and a net 33% expect lower CPI over the next year, the most since 2012. You look forward on expectations for growth, earnings margins, they all continue to stabilize and or improve slightly after the big drop in the fall of 21. These are the numbers, the quotes I'm pulling out of your work, David. It just seems to me that the conversation we're having, you and I, the conversation I have with pretty much everyone on any given day, is a little bit different to what I'm seeing just in terms of expectations.
Well, what we're seeing is that investors are very much expecting that the Fed is in control of it. They think that they're going to see the Fed complete its tapering by April. On average, the expectations for the first hike in July, and they expect 2 hikes in 2022. The expectation is that the Fed is going to be able to manage a sort of soft landing in terms of inflation expectations, that they're going to be able to bring inflation under control. 33% on net expect inflation to be lower next year in 12 months than now, and that's the lowest since 2012. So the confidence is there that the Fed is going to manage it, and you can see that in the asset allocation.
You can see that in some ways in pricing as well. So if that's the consensus view, and to some degree a lot of this is priced, David, you always use this, like other people use this as well. What would you lean against, lean the other way, when you look at some of these numbers, some of these calls?
Yeah, well, you know us. We're instinctually contrarian. So what is great about the FMS is that it tells you what is priced into the market. And our expectation is that the Fed is actually going to have to be more aggressive than the consensus out there. We think that the Fed is going to hike more, certainly more than the 2% that our respondents think. We think they're going to have to go faster. And we think that this is going to eventually have a knock-on effect on growth, on profits, And on margins, we think that unlike the theme coming out of the survey, we think there's going to be a pronounced slowdown in the second half. And for that reason, we favor defensives like staples and utilities.
So out of the three top crowded trades right now, number one long tech, two long Bitcoin, three long ESG, which one would you short, David?
Well, I would probably go with that first one. That is the one that is perhaps the most crowded.
And when you expect higher rates too, could have some difficulty there. David, thank you, sir, as always, for doing this on every single month with us with the Fund Manager Survey. David, thank you for everything this year, sir. David Jones there of Bank of America. Let's turn back to this equity market. Down 18 points, negative 0.4% on the S&P, falling a little bit further back from all-time highs with your sector price action. Here's Kriti Gupta.
Well, good morning, John. Red on the index level, but of course on a sector level, you do have a few in the green. Financials, materials are up in the early trading session. You do have to the downside real estate and consumer discretionary information technology, essentially at the core of it, big tech dragging the market lower, except for one of your major upside movers, and that is going to be Apple. Analysts just getting more and more bullish. The latest, Bank of America upgrading the iPhone maker to a buy on the revenue opportunity from virtual reality products. We should talk about not just tech here in the States, though, but tech across the Pacific and into China. We know Chinese tech has been under pressure this year with the regulatory scrutiny. Chinese ADRs down broadly this morning after an additional broad sell-off in the stocks and bonds of Chinese property firm Shimao after a deal in that flagged corporate governance issues and then again bled into broader sentiment. On a year-to-date basis, the Nasdaq Golden Dragon Index down 42% in 2022. Let's see if that regional divide closes, John.
Kriti, great work as always. Kriti Gupta on top of the market through the day on Bloomberg TV and radio. About 23 minutes into the session, we declined 0.4% on the S&P. On the Nasdaq, down a little more than 1%. On a 10-year yield, a bit of a pop this morning, up 4 basis points on 10s, up 5 on 30s. The curve just slightly steeper, 2 still doing some work, up 2 or 3 basis points on 2s to about 66 basis points. Coming up, the market moving events you need to be watching. That'll be next in our trading diary. From New York City this morning, good morning. This is Bloomberg. 25 minutes into the session from New York City this morning. Good morning. Another morning of losses, potentially another day of losses. A day of losses yesterday, some negative follow through into today. We're down 0.4 on the S&P, down 0.2 on the Russell. On the Nasdaq, we're down a little more than 1%. This from Cameron Christ on Bloomberg in his column this morning. Macro man asking the following question: how can the Fed be hawkish if everybody expects it to be? Switch up the board and get to the bond market. Let's talk about it. Are they hawkish in the dot plot? Or are they hawkish with the balance sheet? Do they start to talk about the sequencing of policy and including that balance sheet reduction? Some questions we can ask through the next 24 hours. Right now, up 3 basis points on twos to about 66, still short of the highs of the year there. And your 10-year, after rolling over yesterday, a little bit higher today, up 4 basis points to 145.48. That's the price action. Let's get you to your trading diary. China releasing retail sales, industrial production and property investment data at 9 p.m. Eastern. U.S. retail sales coming up tomorrow, almost forgotten because we have a Fed rate decision and Chairman Powell news conference after that. The Bank of England and the ECB with their own rate decisions on Thursday. And finally, you'll hear from Fed Governor Chris Waller speaking on Friday to round out the week. From New York City, this was the countdown to the open. Thank you for choosing Bloomberg TV.
We're the realists.
We're the advocates.
We're the grinders.
We're the wonks you've always hoped were out there.
We've taken everything we've learned from our company and we've put it into philanthropies, along with almost all of our profits, which means that with our partners,
we're the builders of stronger communities.
We're the naysayers to anyone who says this planet can't be saved.
And if you're the first in and the last out,
we'll be right there with you.
We're Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, December 14th. Here are all the top market stories that we are following for you at this hour. 2022 inflationary pressures. Prices paid in U.S. producers hit a record 10% in November. We're going to talk to the CEO of the top global supplier for houseware brands, Ravan Gandhi of GMM Nonstick Coatings.
And it's the vaccine vindication. 2 shots of Pfizer's vaccine may offer 70% protection against hospitalization with Omicron, even though it's more infectious. And getting into cash. Bank of America's Fund Manager Survey shows investors have the highest exposure to cash since May 2020. Do you de-risk for next year? We're going to answer that question with J.P. Morgan's Dubravko Lakos Pujas. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. The Fund Manager Survey we'll discuss in a second, Guy. Yes, it is backward looking, but the allocation to cash was quite staggering, and it raises questions as to what have we seen in the last few weeks? What kind of repositioning are we looking at?
Yeah, up until now, it's been about rotation, hasn't it, within the market? And that has been the narrative. Basically, we've had a rolling rotation. If people are starting to shift into cash, that's a very different narrative going into next year. But maybe, just maybe, you take a look at what Mike Wilson is saying. You take a look at what the long-term chart of the S&P looks like. 2000 looks like a blip. 2008 looks like a blip. Maybe it's people starting to look at those charts.
Yeah, do we revisit YOLO and FOMO, or are YOLO and FOMO always going to be here now as long as there's all that liquidity? We'll break all that down.
We will. We certainly will. It's going to be an interesting year next year. A lot of very positive notes coming out at the moment. But as you say, the latest Bank of America Global Fund Managers survey showing a defensive, there it is, shift into cash this month. Cash allocations, as Alex says, went up by 14 percentage points. That's the highest exposure to cash since May 2020, which doesn't actually seem that long ago. This brings us to our question of the day. Should investors decrease risk into 2022? Let's try and figure this out. John Authors joining me here in the studio, Christina Kino joining us down the line. John, let me start with you. The fund managers starting maybe to shift into cash. Is that just a year-end effect, or do you think that is a fundamental review of what central banks are about to do?
I think it's more of a year-end effect. If you take a look at the rest of the survey, what they're expecting from central banks, they pretty much already have on board what seems to be most likely, that we are going to get an accelerated taper, that there probably will be 2 hikes next year, but they don't think that inflation is going to rage out of control beyond there. It's certainly quite interesting that as soon as Powell made his hawkish pivot in the last few weeks, what they saw as the greatest risk switched from inflation to overzealousness by central banks. So that's their greatest cause of concern. I think the issue in terms of whether they should reserve risk is that traditionally when you think in terms of risk on and risk off, when you think of reducing risk, it means buying bonds, which is exactly what you don't want to do.
And that's why they're going into cash, right?
Yes.
They're not buying bonds because they're too nervous about bonds, so they're basically shifting into cash. So cash is now serving the same purpose as bonds?
Conceivably. Apple stock might also be serving much the same purpose.
Except when it gets to $3 trillion market cap, because then you got other questions. Hey, Christine, what are you noticing in terms of how positioning is happening, say, in FX and in the Treasury market? If you're scared of buying Treasuries, then you haven't been scared about buying the dollar.
No, certainly not, Alex. But I think, very much in the same way that we're looking at the big run-up in stocks. The dollar has had a big run-up this year as well, much to the surprise of a lot of people. And certainly questions now starting to come through of whether these expectations that are driving the dollar, which is primarily a tighter Fed policy, is already in price. And so it's going to be interesting to see what we hear from Jay Powell tomorrow when the Fed meets and how that's going to play into the Fed's longer-term trajectory, because that could give a lot of potential for the dollar to pull back here.
Christine, though, consensus at the moment, and Cam Krice is making this point on the M Live, consensus is that the Fed is going to accelerate the taper. It's going to do so reasonably aggressively. That's going to bring forward rate hikes. The expectation is that we're going to see 2, maybe 3 rate hikes next year, certainly 2. That's consensus. What does a hawkish Fed actually look like?
Well, probably they're going to have to beat those already very hawkish consensus expectations, Guy. And that is kind of the problem for the Fed at this moment, is they seem to be getting into a bit of a race with markets into heading down a more hawkish path. It's very similar to what we've seen, for instance, with markets in the Bank of England, and we know how that ended, right? We're seeing now markets paring back those very, very hawkish expectations for the Bank of England, especially in light of the developments in the UK over the last couple of days. And so I'm not saying that we might see exactly the same situation for the Fed, but it's certainly getting to that stage where markets seem to be
Oh, looks like we're having a connection
It just
issue.
depends on how they respond.
John, in terms of, say, then where you go for safety, you mentioned Apple. The fund manager survey was very much that individuals are long tech, but also long Bitcoin. Is Bitcoin safety now? Is it cash in Bitcoin and shorting treasuries?
I hope not. I don't regard it as safety. It seems to be behaving more like a risk asset. It's one of the things that goes up when people are worried. When people are excited. It's one of the things that correlates, broadly speaking, with Tesla or with things that you buy when people are feeling positive. It is, I have to admit, it's very interesting that it's actually managed to do as well as it's done when gold and silver are actually at this moment still down for the year.
Yeah.
So in terms of the idea that they might actually replace gold and silver as conservative stores of value,
They feel like different things.
Yes.
In an economic cycle, you're a student of history. In an economic cycle, when we get to the point at which the Fed starts tightening, the Fed starts withdrawing stimulus, what is the norm? What is the historical story about how assets then react? And is this, like, I hate to say this time is different, but given what has come before it, are those parallels useful?
I suspect we might want to go back to pre-2000 or even pre-Volcker parallels being more useful at this point, because the question we need to ask is, if there really is inflation out there, then the inflation itself becomes much more of an important variable. I think the Fed could be much more hawkish next year if inflation is still as high as it is now in 6 months' time, for example. And that becomes part of the equation. In general, if you are fighting inflation and you need to keep raising rates to do it, then that's not good for the stock market or the bond market.
All right, guys, thanks a lot. Really appreciate it. Bloomberg's John Authors and Christina Aquino joining us. And tune into our special coverage, The Fed Decides. That's tomorrow, 1:30 p.m. New York time. All right, coming up, we're going to break down this conversation even more. Should you de-risk into 2022? Well, JP Morgan says not so much. S&P forecast for next year among the most bullish. Dubravko Bujas, JP Morgan, global head of equity macro research, sees further stock upside ahead. Maybe just not as much as this year. He'll break us down with his call next. This is Bloomberg.
Changing world.
All right,
right, let's get to that question of the day. Do you de-risk into 2022? Dubravko Lakos-Bujas, JP Morgan Global Head of Equity Macro Research, joins us now. Dubravko, what's the answer to that question? Do you de-risk in 2022, and what parts might you de-risk?
So we think the construct for equities remains positive. You know, when you sort of look at the market, you know, people obviously refer to S&P 500 index, which continues to sort of hover close to highs. But when you basically look at everything underneath and everything outside of S&P, you've already seen a pretty heavy dose of de-risking. You know, last I looked, when you look at the median and the average stock within S&P, peak to trough, it's down 15, 16, 17, 18%, and the drawdown has been happening now for over 30, close to 60 days. And when you look outside of the U.S., international markets, EM markets, I would say the situation is already pretty de-risked. So I think it's really the mega caps in the U.S., the top 10 stocks that are holding the ground here. And I think one of the reasons for that is because just simply lack of alternatives. People don't want to go into bonds. And there is still pretty much, the system is pretty much flush with cash. They don't want to touch high beta stocks. They've de-risked already a decent amount. So they just go into sort of the call it the bond proxies, the mega caps that generally have relatively decent fundamentals. Valuations are not as crazy, and they have pretty healthy capital return to them. So that's kind of, I think, the backdrop. I don't think you can just look at S&P and sort of say market is at highs. You got to look at everything else around it.
How bumpy is the ride going to be in 2022, do you think? There's going to be a lot of things to think about. We're going to have to figure out more precisely what the Fed is going to do. There's certainly risk, it seems, to the upside that the Fed is going to be more aggressive. As we figure that out, where do you think volatility is going to be?
So look, I think that volatility between now and probably end of 1Q will be on the higher side because, you know, everybody's sort of looking at what the Fed is going to do. We basically need to see how inflation comes in. And so I think, yeah, there's going to be high vol and there's going to be a bit of a roller coaster ride. But I think if you sort of cut through all of that, just given where expectations are, I would ask the question, you know, where will there be the bigger surprise? Is the bigger surprise going to come from Fed being even more aggressive than what's being priced in at this point? Or could the basic Fed surprise of being somewhat more balanced?
Let's talk about Omicron and how that feeds into the whole thing. So we're getting more restrictions globally, whether it's travel restrictions, work from home restrictions. What does that do? Is that a growth story or an inflationary story? Because that's going to directly impact the market rhetoric around the Fed.
So as far as the latest variant goes, again, we don't want to get ahead of ourselves, but from all the data and all the analysis we've done, we don't think it's going to really alter the outlook in any sort of significant way. Could you get a bit of a delay in the demand cycle and so forth? Absolutely. But I don't think it changes the outlook in any meaningful way. Transmissibility is high. Severity from everything we continue to see seems to suggest it's not worse than the prior waves. And we do have still the vaccines. We have boosters and we have antivirals that I think should help basically put a floor underneath this issue. So we don't think Omicron is that big of an issue. At this point, we really think it's primarily around the Fed and how aggressively the Fed moves.
What is retail doing right now? And I'm not talking about bricks and mortar, I'm talking about retail investors. What is their perception of risk? When you think about this market, it has changed this year. Retail has become a force to think about if you are a professional investor. Do you think retail investors are going to be as aggressive next year when they look at this market? They've got a whole range of other things to think about. You've got a bumpy crypto story. You've got high gas prices. The list just goes on. And then you factor in rising interest rates as well. Just in terms of the supports for the market, kind of where do you see the fragility?
So I think that, look, retail plays an important role. Retail, equity allocation has gone up. But I think on a sort of, so I think for retail to become a risk, you would really need to see a pretty significant unwind in financial markets. You would need to see, if the crypto space completely collapses, that's a risk, But again, I think retail participation within equities, from everything we're seeing based on our internal models, tends to be very much so theme-specific, stock-specific, rather than necessarily just broad-based, equities. And so, where does retail go next year? Retail, I think you look at a job market, it's healthy. You look at balance sheets of retail, it's probably the best it's been in probably a decade or two. You look at savings, they're still there, excess savings. So question is just, does retail have power to basically step in further? Probably yes, but I think a lot of it is a function of sentiment. And so, I just don't see retail really stepping out in any meaningful way unless the market completely sort of starts to roll over and some of these other, call it, areas such as crypto roll over, at the same time.
So as long as like YOLO and FOMO and the retail guys, as long as all of that remains true, what do you buy in a dip?
What I would be buying at a dip right now is just simply put high beta stocks. High beta stocks. They've sold off quite aggressively over the last 8 to 9 months. People right now are basically paying back to close to record premium for low beta and safety and low vol. So what do I mean by high beta? I mean high beta within cyclicals. I think the travel theme has an exceptionally attractive risk reward for 2022. The travel theme. No reason why summer of 22 won't be better than summer of 21 or summer of 2020. And yet these stocks are basically trading back, many of them, to June levels of last year. Energy theme, I think, is phenomenal. Very attractive risk reward as cross-border activity continues to normalize. And then I think on the growth side, there's a lot of fire sale. And there's a lot of very attractive high beta opportunities there. I mean, just look at a lot of these speculative growth names. They're down 30, 40, 50% from highs. So I would be looking at high beta on both sides of the barbell. That's where I think the most attractive opportunity is going into the first half of next year.
Dubravko, does the high dollar, does the strong dollar, which we may see as we see policy divergence, keep US money in Europe? The performance difference for a US investor investing in Europe versus a Euro investor investing in Europe is absolutely enormous at the moment. It works the other way around. European stocks, European investors getting a good ride. Just sort of geographically, when you think about how you want to invest next year, how big a factor, how big an FX factor should I be thinking about when I talk about my portfolio?
So FX plays a role, but again, I think you really need to see a big move in FX for that to make a big difference. So again, for the dollar, you would probably need to see a 4, 5, 6% move rather than just sort of a 1 or 2% move. And so I think within emerging markets, yes, it's played a very big role. Within, I think, Europe, it's played some role, but less so. I think EM is the bigger one. Look, we think that as you think about 2022, in line with sort of this high beta thesis, we think Europe within the developed space and we think emerging markets within a global context both possess attractive risk reward. And one of the centerpieces, obviously, is China, which has been in a deleveraging mode for the last 12 plus months. And we're definitely seeing signs of pivoting there, which we think should persist as we go into next year. So again, S&P 500 US happens to be very concentrated, very sort of heavy in terms of mega caps. We think it's time to sort of diversify.
Okay, we're going to get to China in just a moment, but one last quick question on Europe. Does the money leave the U.S. and go to Europe? Where does the money flow out of if you're going to take on that beta?
So I think where you could basically see the money flow out of is the mega caps. It's basically, that's where all the money has been going. You're basically seeing record concentration, globally in 30 plus years. So I think that in the first half of next year, assuming inflation basically shows signs of normalization, which we think it will, assuming the Fed ends up being somewhat more balanced and doesn't just continue to basically aggressively move forward with tightening, which I believe the market is pricing in, but it still remains a big question mark. And assuming that the COVID situation starts to come back under control, and I know we're dealing with a lot of headlines now, I do think that you get a rotation from, like I said, lower beta mega caps, where all the money has basically been funneled into higher beta, which includes both higher beta within the U.S., but includes higher beta abroad, which is Europe and parts of EM.
Dubravko, let's dig into that in just a moment. I want to get your take on where you want to be positioned in Europe. Dubravko Lakos-Bujas joining us from JP Morgan. We're going to talk about one of their top 2022 trades, overweight Chinese stocks. That has been certainly a tough trade this year, certainly when it comes to the mega cap names with exposure in the United States in the form of listings. We'll talk about that next. This is Bloomberg.
human, it's just work.
22 minutes past the hour. So JP Morgan's call on 2022? By everything. China. 3 of the bank's top 2022 trades involve bullish calls on Chinese assets, including going long local bonds, long the yuan versus the euro, and overweighting Chinese stocks. Dubravko Lekos-Bujas, JP Morgan's global head of equity macro research, still with us. China's been a really tough call this year. Really tough. Why is next year going to be different?
Well, in a nutshell, we think that sort of everything that could have gone wrong with respect to China has gone wrong, both on the sort of, regulatory side, on the policy side. Yes, China has been a very tough one. Sentiment and expectations on the China side are very low. Positioning, when you look at various sort of numbers, has also basically completely capitulated. And so we just don't think that the story's over. We think that China as a long-term as long-term as an economy, as a fundamental story, we believe generally remains intact. It's just gone through a pretty aggressive rebalance this year. And I think as you go into 2022, we think there is a pretty large opportunity for the multiple and for sentiment to improve off of, I call, extreme lows and relative to expectations. So that's why, again, it's very hard to sort of exactly time and pinpoint when the pivot happens, but I think generally speaking, you want to be looking at allocating greater risk to China over the coming quarters.
So, Dubravko, what kind of policy, either fiscal or monetary, does that inherently imply?
So we are seeing, on the fiscal side, there's basically been negative fiscal. There's been a fiscal drag, essentially. Credit impulse has been negative. We're starting to see signs of that pivoting. Question is now obviously how big of a pivot you get. We think we'll definitely get some pivot. Question is just how big. On the monetary side, we're seeing talks of just generally triple R cuts. And then on the regulatory side, they've basically gone after multiple industries, multiple key sectors that the foreign world has had a lot of exposure to, so people have gotten burned. And we think the regulatory pressures definitely will be easing in the coming period. So it's a question of putting all of these, if you will, together.
Yep. Dubravko, let's turn to Europe. Less impressive performance this year, you could argue, than the US, but nevertheless, by European standards, incredibly impressive. The two basically are still neck and neck. But if you take a look at what has performed in Europe this year, it's been tech and it's been the banks. Are those the sectors that are going to carry on performing into next year?
So we think banks have the potential for continuing to perform, not just within Europe, but call it globally. Tech, I think, is the area where which I think is a little bit tough. We're more neutral on tech, and largely because we expect to continue to see large dispersion. Mm-hmm. So, for instance, we like high beta over lower beta tech at this point. But I would say other areas that I would highlight is consumer. I think a lot of consumer-based areas within Europe, even on the luxury side, have relatively attractive risk-reward, especially if you believe the China story has room to improve off of the lows and to pivot.
Dubravko, 30 seconds. Question from the IB chat here. Are you concerned of the ADR delisting?
Not in the near term. It is a risk, and it is something that is not going to go away. I think that a decent amount of negativity is already priced in. Look, we are basically looking at a 2 to 3 year time frame. A lot can happen between now and then. And so I think at this moment, it's not a risk. I don't think it's a risk for 22, but perhaps something worth revisiting later on.
All right, Dubravko, and in 2 years in COVID time is a whole different story, too. Dubravko Lekos-Bujas, JP Morgan Global Head of Equity Macro Research. It was a real pleasure. Thank you so much. It's been way too long. We look forward to having you back. All right, coming up, U.S. producer prices jumping. We're going to speak to Robin Gandhi, GMM Nonstick Coatings CEO, next. This is Bloomberg.
fitness, nutrition, and community so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
It's such an interesting new world.
The world is changing. For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I don't think it's the great resignation. I think it's the great reshuffle, and people are reflecting on what do they want and how do they want to work and how do they want to live their lives.
We're just about an hour into trading right here in the U.S. The Dow trying to get into positive territory, but the Nasdaq still up by about 1 percentage point. Bloomberg's Abigail Doolittle is here with all the market moves here. It was like a PPI, bad news, good news kind of thing.
Yeah, and ultimately bad news, or at least skittish news. We have the S&P 500 down about 0.5% down for a second day in a row. The Nasdaq 100 down even more, down about 1%, also down for a second day in a row. And of course, this is Fed week. At this point, we see bonds lower. So a little bit of a mixed tone because you have growthier stocks down, but you also have haven bonds down. But take a look at the spike in volatility. That VIX up 20 at 22, so above 20. So we're out of complacency. Interesting picture. It seems like we're back and forth, back and forth. If we go into the terminal, we're going to see an interesting picture too, because investors are starting to take notice. What we're looking at here in blue is the S&P 500. In white is the put-call ratio. So when it goes higher, it tells you that investors are concerned. So they were concerned in July and then down, down, down. But the point I want to make here is over the last month, even as the S&P 500 was rallying, the put-call ratio is going up. So clearly, or it would suggest some investors are hedging. But you can see that put-call ratio still relatively high, suggesting that investors are, again, a little bit on edge, as suggested by the VIX. And supporting this picture, investors just don't know what to make of all the macro uncertainties between the virus, the Fed, inflation. Commodities are also sliding. That Bloomberg Commodity Index down on the day, down, I believe, for a second session in a row, down about 0.6%, really being weighed on by oil, natural gas, and silver. And of course, oil and natural gas guy tells on the economy in terms of the global growth expectations, and perhaps you can make a little bit of a case about that around silver too. Silver down well more than gold because of some of the industrial uses, guys. So a bit of a cautious tone for a second day in a row.
Yeah, it does kind of feel like that, and it's interesting. Obviously, the Fed meeting starts today. We get that result tomorrow. That's got to be factored into all of this. Who knows? Could we get a hawkish surprise? Abigail, thank you very much indeed. Let's talk about some of the inputs the Fed is going to be thinking about. Prices paid to U.S. producers rose more than expected last month. For more on rising input costs, let's bring in Raveen Gandhi, GMM Non-Stick Coating CEO. GMM is not only a fantastic Bloomberg function, but GMM is also a supplier to houseware names most of us know: KitchenAid, Pyrex, Black & Decker, all of those kinds of great things that you have in your house. Raveen, nice to see you. Thanks for your time today. We always appreciate getting an update on what is going on. Look, final demand, US PPI rose 9.6% year on year. Do you think that number is underplaying the reality of what the factory story is right now?
So when I spoke to you a couple months ago, I mentioned that we had raised prices around 15%, up to about 25%. So yeah, I do think there probably is some understatement there. And, you know, it clearly, given the numbers we're seeing, this stuff is all ending up at the foot of the U.S. consumer.
But so far, Raveen, we haven't seen any real decline in demand hit for that. We talk a lot about household spending power. We talk a lot about the dry powder just stored up, kind of waiting to be spent. Where have you noticed any consumer hesitancy if you've had to increase prices upwards of 25%?
So obviously we're a tier 2 supplier, so all of my POs come from the big manufacturers. So we're kind of trying to read the tea leaves. The truth is, the biggest reason why we've seen a slowdown in November and December is supply chain stuff. So our big American our big American clients are a little bit gun shy to put in POs because of all the shipping and the supply chain stuff. In terms of inflation, I agree with you. A little inflation, has not seemed to hurt anybody. But I started my business in 2007, And I remember everyone was so optimistic, and in 2008, we almost went under because of that recession that nobody saw. So I'm always a little bit nervous that when you have unexpected consumer pressure, things can change very quickly. And I know we haven't seen it yet, but that's what kind of keeps me up at night.
Just in terms of just backing up to the supply chain story, any sign that things are easing up? Any optimism, any green shoots about maybe things starting to get a little bit better?
Yeah, about 8 weeks ago, we had about 120 containers piled up at various ports in China, on their way to the West Coast. That number has been cut in half at this point. So I definitely see it getting better. Perhaps it's related to some of the action the administration has taken with the ports. I'm not really sure on that, but it definitely seems to be, getting better.
On the flip side, Raveen, I'm wondering, with the Omicron cases that are climbing everywhere, we've seen certain areas of China that needed to shut their ports again because of that zero tolerance COVID policy. Do you have any sense of kind of what you're looking at in the next 3 months or so?
I think from a COVID perspective, it's actually still pretty bad in China. I don't mean from a cases perspective. I just mean from a shutdown and regulation perspective. This stuff is changing all the time. We have a few plants in China. We have an office in Hong Kong. We have a lot of people in Hong Kong who have not been to China in 2 years because you take a day trip and you have to do a 2-week pre-quarantine, a 2-week quarantine when you get there. So it can take over a month to just go back and forth. So people obviously aren't doing it. So it is definitely a mess from a COVID perspective. And that has been one of the biggest challenges. On top of that, we've had people who were based in one of our Asian locations this year come over to the States a few times. And suddenly, in one case, a guy was trying to get on a flight in San Francisco to go back to Beijing. And suddenly they didn't let him on the plane because China had just changed a regulation that you needed a test that was within 24 hours. So he had to wait an extra week in San Francisco, go to the Chinese embassy, which is highly non-communicative, get a test. And so China is really, really tough on COVID.
So given all of that, given what you said about the China story, the supply chain story, what's happening with the US consumer, what does next year look like? You've raised